What most people don't realize is that cash is not actually as safe as it feels. It looks stable on the surface. The number in your bank account stays the same, your balance doesn't swing around, and you can open your app at any time and feel a little sense of relief. But this is where it gets dangerous. Safety is not just about whether the number goes down tomorrow. Real safety is about whether your money can still buy what it needs 5 years from now, 10 years from now, or 20 years from now. And if you're holding too much cash today, it's slowly costing you in ways that are easy to ignore and hard to reverse. It feels safe, but it's slowly costing you through inflation, through lost compounding, and through missed ownership in the assets that actually build wealth. A lot of people think the biggest financial mistake is taking too much risk. Sometimes that's true, but for many intelligent, hard-working people in the United States and Canada, the more common mistake is the opposite. They avoid visible risk so aggressively that they accept invisible loss. They protect themselves from market swings, but they never protect themselves from the silent erosion of purchasing power. They fear a temporary decline in asset prices more than they fear a permanent decline in what cash can do. And that psychological bias matters, because wealth is not built by preserving the appearance of safety. Wealth is built by understanding what truly compounds over time. If you want financial clarity, this is one of the most important mental shifts you can make. Cash has a role. Emergency funds matter. Liquidity matters. Stability matters. But cash is a tool, not a destination. It's for flexibility, not for long-term wealth storage. The smarter move is shifting more of your money into assets that protect and grow value over time, while still matching your risk tolerance and time horizon. Here are assets that are generally better and safer than cash in today's financial world. And when I say safer, I don't mean they never move up or down. I mean safer in the deeper sense. More likely to preserve purchasing power, more likely to create future income, and more likely to help you build real wealth instead of watching your savings quietly shrink. Let's start with the foundation: broad stock market indexed funds, especially those that track something like the S&P 500 or the total market. This is one of the clearest examples of assets better than cash for long-term investors, because when you buy a broad index fund, you're not betting on one company, one CEO, or one trend. You are buying a slice of productive business activity itself. You own businesses that sell software, medicine, food, equipment, banking services, energy, logistics, and thousands of daily necessities. Cash sits still, businesses adapt. That's the difference. Oscar, a 35-year-old engineer, kept nearly $200,000 in cash because he said he was waiting for the right time. He told himself he was being disciplined. In reality, he was using caution to hide uncertainty. Year after year, prices rose, the market moved, and his money stayed parked. He didn't lose half of it in a crash. He lost something quieter. He lost years of compounding. He lost the chance to own productive assets while inflation steadily reduced what that money could buy. When Oscar finally started moving part of that cash into a low-cost index fund every month, the biggest change wasn't just in his portfolio, it was in his psychology. He stopped thinking like a protector of numbers and started thinking like an owner of assets. That is one of the best assets to build wealth because it turns your mindset away from guessing and toward participation. You do not need to predict which stock will double next year. You need exposure to broad economic growth over long periods of time. And for people looking for financial independence strategies, broad index funds are powerful precisely because they remove ego from the process. They reward consistency, not cleverness.
Now, some people hear that and immediately think, yes, but stocks are volatile. That's true, which is why the next category matters: high-quality government bonds, especially U.S. Treasuries. Bonds are not exciting. That's part of their value. In a world obsessed with dramatic upside, boring assets often do the heavy lifting of stability. A high-quality government bond is essentially a loan to a government with very strong credit quality. In exchange, you receive interest and a defined structure of repayment. For someone who wants safe investments rather than speculation, treasuries can make a lot of sense as part of a balanced plan. Lily, a nurse in Texas, used to think she had only two choices: leave money in cash or put everything into stocks. That false choice kept her stuck. Once she understood that treasuries and short-duration government bond funds could serve as a middle ground, everything changed. She kept a healthy emergency reserve in cash, then moved some medium-term money into government-backed bonds and some long-term money into index funds. Suddenly, her portfolio matched her actual life. Cash covered the next few months, bonds covered stability and income, stocks covered the future. That is how rational investors think. They stop asking, what is the one perfect place for all my money, and start asking, what job does each dollar need to do? That question alone can change your financial life, because a lot of bad decisions come from giving cash a job that cash cannot do. Cash is good for immediate spending, emergencies, and optionality. It is not good for long-term growth. It is not good at helping you protect money from inflation over long stretches, and it is definitely not the best answer for everything. Then there's real estate, which remains one of the classic assets better than cash, because it offers two things cash never can: income potential and tangible utility. A quality rental property can generate cash flow while also appreciating over time. Real estate is imperfect. It requires maintenance, local knowledge, and patience. But psychologically, it teaches a profound lesson. Wealth often grows through ownership of things people need to use. People need housing. They pay to live somewhere. That creates a different relationship with money than simply letting it idle in an account. Oliver and his wife spent years saving aggressively, but every time they got close to buying an asset, fear pulled them back. What if the market drops? What if repairs cost too much? What if now is the wrong time? Those questions sound logical, but underneath them was a deeper emotional pattern. They were more comfortable with the certainty of stagnation than the uncertainty of progress. Eventually, they bought a modest duplex in a growing area outside a major city. It wasn't glamorous, it wasn't a social media investment, but over time, rental income helped cover the mortgage, the property appreciated, and they gained a deeper understanding of leverage, location, and patience. They didn't become rich overnight. They became sturdier, and that's what real wealth building often looks like. For people who don't want the responsibility of owning physical property, REITs, or real estate investment trusts, can be an elegant alternative. REITs give you real estate exposure without the broken water heater, tenant turnover, or direct property management. You can own shares in portfolios of apartments, industrial facilities, data centers, medical buildings, or retail spaces. That means you can participate in real estate as one of your passive income investments while staying liquid and diversified. It's especially useful for people who understand the value of real estate but don't want all their capital and time tied up in one building. Gold is another asset people misunderstand. Gold does not produce cash flow like a business or a rental property, and that matters. But gold has survived for centuries as a store of value because it plays a different role. It is less about growth and more about resilience. In times of inflation fears, currency weakness, or broader distrust in financial systems, gold often becomes attractive because it cannot be printed in the way currency can. If cash is a claim on purchasing power, gold is a hedge against the possibility that those claims are being diluted. Leo, who works in logistics, used to dismiss gold as outdated. Then he realized he was making a category mistake. He was comparing gold to growth assets when he should have been comparing gold to fragile confidence. Once he saw gold as portfolio insurance rather than a wealth engine, it made more sense. He didn't move everything into it. He allocated a small portion as protection, not as a prediction. That's an important mental model. Not every asset in your life has to maximize return. Some assets exist to stabilize the whole system. Dividend-paying stocks occupy an interesting middle ground between growth and income. These are companies that regularly return part of their profits to shareholders, and they can be especially appealing to people who want their assets to feel more tangible. Psychologically, dividend-paying stocks help some investors stay committed because they see actual cash flow arriving. That can reduce the emotional urge to sell during volatility. More importantly, many dividend-paying companies are mature businesses with durable cash generation, which can make them attractive as part of a long-term strategy.
Freya, a project manager in Ontario, used to keep a large cash buffer because she said she liked knowing it was there. What changed her behavior was not a spreadsheet. It was the experience of receiving quarterly dividends from a basket of high-quality companies and broad dividend ETFs. For the first time, money felt like it was working with her instead of just sitting beside her. That emotional shift matters. People often cling to cash because it feels controllable. But control without productivity is not financial security. True security is created when your assets begin producing income, appreciation, or both. This is also where ETFs become so useful. An ETF, or exchange-traded fund, is not one asset type, but a structure that lets you own many assets efficiently. Through ETFs, you can hold the S&P 500, dividend stocks, government bonds, gold, infrastructure, international equities, or real estate sectors in one simple vehicle. If you're asking where to put money instead of cash, ETFs are often one of the cleanest answers because they solve several problems at once. They lower the concentration risk, reduce the temptation to stock pick impulsively, and allow gradual, disciplined investing. That makes them especially helpful for busy professionals who want safe, wealth-building assets without turning finance into a second full-time job. Now, there is one category that sounds close to cash but is still worth separating out: high-yield savings accounts and money market funds. These are not wealth-building engines in the same way stocks or real estate are, but they are still often better than leaving money in a traditional low-interest checking or savings account. If part of your goal is capital preservation with some yield, these can be excellent tools. They allow your short-term reserves to earn something while keeping liquidity relatively high. In other words, this is not where you build your future fortune, but it may be one of the safest places for money you need access to soon. That distinction is important because smart investors don't eliminate cash, they optimize it. Your emergency fund, near-term bills, tax reserves, or upcoming down payment money should not be thrown into volatile assets just to chase returns. The goal is not to turn every dollar into an aggressive bet. The goal is to stop wasting dollars that are meant for long-term growth by storing them in places designed for short-term stability. Land deserves more attention than it usually gets, especially land near urban expansion corridors or areas with long-term development potential. Unlike a trendy stock, land often rewards patience and vision. It may not produce immediate income unless used productively, but as cities expand, infrastructure grows, and population shift, strategically located land can become more valuable simply because of where it is. Land is finite. That matters. It is one of the few assets that cannot be manufactured more of in the places people increasingly want to live, build, and move through. That said, land requires homework. Zoning, taxes, access, and long holding periods all matter. This is not an emotional purchase, it is a strategic one. But for the right investor, it can be a strong answer to the question of how to protect money from inflation over very long periods, especially when paired with a patient time horizon and realistic expectations. You can also look at commodities or infrastructure-related assets, especially through diversified funds. Why? Because modern life depends on physical systems. Energy pipelines, utilities, transportation networks, industrial materials, and essential commodities sit beneath the entire economy. These assets may not always be exciting, but they often benefit when inflation rises or when hard assets become more valuable. Again, the key is not to treat them like a trend. The key is to understand them as part of a broader diversification strategy. And that word, diversification, is where this entire conversation comes together. Many people looking for safe investments make a hidden mistake. They believe safety comes from concentration of cash, but real safety often comes from thoughtful diversification across assets with different behaviors.
Stocks for growth, bonds for stability and income, real estate for tangible cash flow and appreciation, gold for resilient, high-yield cash vehicles for liquidity, REITs, dividend-paying stocks, land and infrastructure for balance and exposure to different economic forces. Safety is not about freezing your money, it's about distributing your risk intelligently. The deeper issue, though, is psychological. Why do people cling to cash even when they know inflation exists? Because cash reduces emotional discomfort. It gives the illusion of control. It delays decision-making. It protects people from regret in the short term. If the market falls next month, the person in cash can say, "See, I was right to wait." But if prices rise for 5 years and inflation slowly eats away at their savings, that pain is harder to feel in real time, so the mind discounts it. Human beings are wired to react more strongly to visible loss than invisible decay. That is why opportunity cost is one of the underappreciated concepts in personal finance. The money you don't invest is not neutral. It has a cost. The years you sit on the sidelines are not free. They shape your future. They change how much freedom you will have later, how much passive income you can generate, and how long it may take to reach financial independence. The real question is not just, could this asset go down? The real question is, what happens if I do nothing for the next decade? Once you think that way, the conversation changes. You stop chasing certainty and start building resilience. You stop asking for perfect timing and start using the process. You stop treating cash as a long-term sanctuary and start treating it as a temporary parking space. That mindset is how serious wealth gets built. Not through hype, not through extreme promises, and not through random speculation, but through steady ownership of assets that can outgrow inflation and produce value over time.
So, if you're wondering where to put money instead of cash, start by being honest about your timeline. Keep enough cash for emergencies and short-term needs, but for the rest, begin shifting deliberately into productive assets. Broad index funds, government bonds, real estate, REITs, dividend-paying stocks, gold, high-yield savings tools for near-term reserves, land when it fits your strategy, maybe some infrastructure or commodity exposure through diversified ETFs. The specific mix will vary by person, but the principle remains the same. Long-term money belongs in assets, not in idle currency. And that brings us to the deeper truth. Cash is not truly safe. It is stable but declining. It protects the appearance of value while quietly losing real-world purchasing power. Wealth, by contrast, is built by owning assets, by owning businesses, land, real estate, productive systems, and cash-flowing vehicles that can adapt with the world instead of being eroded by it. The people who build lasting wealth are usually not the ones chasing the most exciting idea. They're the ones who understand this simple principle early. Currency is temporary, but ownership is enduring. Smart investors don't eliminate cash, they optimize it. They keep some for flexibility, but they do not confuse flexibility with growth, and they do not confuse stillness with safety. If you want your money to protect your future, your money has to do more than sit there. It has to participate.
If there's one idea I want you to walk away with today, it's this. Money sitting still might feel safe, but over time, it's quietly moving you backward. The real shift happens when your money starts working for you, not just sitting beside you. Now I want to ask you something. Right now, are you holding on to cash because it truly serves your future, or because it simply makes you feel in control? What would your financial life look like in 5, 10, even 20 years from now if you keep doing exactly what you're doing today? And on the flip side, what could change if you started moving, even slowly, into assets that grow, produce, and compound? Think about that. Because wealth isn't built in one big moment. It's built in small, consistent decisions most people ignore. So tell me in the comments below, what's one asset you're thinking about investing in after watching this? And what's been holding you back until now? I read every single comment, and I'd love to hear your thoughts. If this video made you think differently about money, go ahead and hit that like button so that more people can see it. Share this video with people who are still keeping all their money in cash. They might need this perspective. And if you want more in-depth, practical insights on financial psychology and building real wealth, make sure you subscribe to this channel and turn on the notification bell so that you never miss what's coming next. Your future self is built by what you do today, so don't just protect your money, make sure it participates. I'll see you in the next video. Have a wonderful day.